What's your primary financing on your deals? So almost all of our deals, we use private money at first. So we borrow money from friends and family, secured against first position mortgages. We don't pool money. We one investor, one property. We borrow 100% of the purchase price, and we borrow 100% of the rehab costs. Now, the what makes this work is we stay at or below 75% of the after repair value. So if a property is worth $100,000, then we're not going to spend more than $75,000 on that property between both the purchase price and the rehab costs. Now, I get that this is impossible to do in some markets, which is why you should consider moving to the Midwest if you're looking at copying my model in just like a cookie cutter type format, which I would not be offended by at all because I am 100% copying one of my mentors' business models. And then, so long as you are able to get into and rehab the property for 75% or less of the after repair value, then when you can get a couple of these together, and then you can approach a commercial lender or a portfolio lender, and you can do a cash out refinance of multiple properties at one time. So then, when we do that, we generally are able to do 75% loan to value when the market is really thriving. Some commercial banks go up to like 85% of the loan to value. And then when the market is tightening up a bit on the commercial lending side, sometimes they might go as low as like 70% or maybe even 60% loan to value. That way they can hedge their bets against the market as well. So we think the 75 is a fair conservative number given the historical way that the banks work. So then we take that cash out refinance from the lender. We pay off the investors that we've been paying 10 and 12% interest only on a monthly basis to. And 10 to 12% interest only is a fantastic return for a lot of people. And most people at this point are a little bit leery of the stock market. So they're looking for alternative ways of investing their funds. There are a significant, I mean, trillions of dollars just sitting in retirement accounts at the moment, unused, like out of the market, because people aren't comfortable with the risk associated with the stock market and the lack of accountability, dare I say. So I would say if you're just starting out in real estate investing and looking to scale and wanting to utilize other people's money, I would say educating yourself on how to coach people through taking their retirement funds from employers that they've left and rolling those into self-directed IRAs it would be a very worthwhile thing for you to do. That way, when you meet somebody that has a stagnant retirement account that they're just letting it sit in an account outside of the market, you can say, hey, unlike the stock market, investing in first position mortgages, you have an underlying asset. So in the event of default, you're able to foreclose on the asset and then you own it outright. You get an interest only monthly payment that's like written into the promissory note. So it's not like when the property performs, you get paid. The way that, we have everything structured is we make payments regardless of whether the property is rented out, regardless of whether rent is collected, regardless of how much that property needed for like any sort of maintenance items or repairs. It's a real win-win because they're utilizing their investment accounts in a way that there is accountability, in the way that there is an underlying asset that can be repossessed in the event of default or in the event that their security or their investment isn't performing. And you are able to rebuild some of these distressed homes and build a portfolio for yourself. So you win, the community wins because now they have one less derelict property on the streets, and the investor wins because they're getting an above average return with an immense level of accountability. And another reason that another one of the selling points that I have on these private investors is just because the way that we calculate and analyze our properties, we don't go above 75% of the loan to value. So if we borrow $75,000 on a home that's worth $100,000, if for whatever reason we default, which we have no plans of doing, the investor receives a property free and clear because they're the ones that hold the lien against the property. A free and clear property worth $100,000, and they bought it for $75,000. So we're giving them 10 and 12% interest only. So let's say the property is rented out, or they're receiving $750 a month at 12%, 1% per month. So their monthly payment is $750. Well, the only reason we would do this deal is if the property is rented out for at least $950 or $1,000 per month, or greater. So in addition to getting an asset that's worth more than the amount of money they've spent on it, their monthly cash flow is going to increase from the 750 to whatever the rent is. So that's important to note. So that's our primary financing for deals. Long story short. Thanks for watching that clip. I thought that was a good question. And I think you can ask good questions too. Join us every Friday morning at 8 a.m. Eastern Standard Time for a live stream Q&A where we answer plenty of questions just like this one. In the meantime, consider subscribing to the channel if you want more of this content. And if you want to increase your deal flow, analyze properties better, and help me feed my family, click the link below for a free 7-day trial of PropStream.